uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the...
What's up, everybody? I quickly wanted to stream. I'm a little bit late. I'm very late, actually. I'm sorry, but I was eating, so I had to hurry up a little bit. Yeah, all right. You can hear me now. I'm going to turn off, or at least I'm going to turn down my audio, and I'm going to turn up Jerome Powell's audio, so you can hear that. Let me know if the audio is all right, because I do not know. All right, I had to set up the stream really quickly, so I'll turn off my own sound right now, or at least turn it down.
Continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. And immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs-to-workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation,
This is actually quite bearish, what he's saying, but Bitcoin is still reacting positively to it.
Households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum.
Yeah, okay. He's just saying what he always says. All right, it's maybe these questions get interesting, which are blasting through my head right now. But maybe these questions will get interesting. But so far, it's like nothing. All right, he's saying nothing about the longer term monetary policy, which is the most important thing. Nothing new, at least. It could be that later he will actually say something about that. So right now, which we'll take a look at, but so far Bitcoin's reaction has been positive. I'm not sure if it's going to remain positive. I see no reason why Bitcoin should be bullish. I also see no reason why it should be bearish. So that can be seen as something bullish, right? If you know what I mean. But we'll see. All right. I expect volatility, and Bitcoin, in my eyes, could still go both ways. All right. So let's listen in again.
Stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. Things are fluctuating back and forth. That's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any.
Okay. Okay. Yeah. I can talk a little bit. By the way, I mean, the start of this stream was pretty quick and a little bit chaotic because I was just eating about 15 minutes ago. So I'm happy to have you all here. Welcome to the stream. Welcome to the channel if you're new. What he just said was a little bit bearish because the reporter asked if he thinks the policy right now is not restrictive enough. And I'll click that away for a little bit less distraction. He asked if the policy right now, so their monetary policy, is restrictive enough or not. And he's saying no, which is the right answer because the inflation rate in the US is still 3.5%, which is too high. But yeah, so that's a little bit bearish. That's also partially why the price is dropping down now. We initially saw some strong bullish momentum. If I would have to predict what's most likely right now, is that nothing will happen. So that's going to be nice. But to be honest, I mean, most of these interest rates press conferences are just up and down. And that's what we're seeing right now. And then afterwards, we will just see, we're probably going to get a big move from Bitcoin in the next 24 hours. All right, that's almost guaranteed. But it's hard to say in which way that will be, all right? And I do not think that this press conference and the interest rate in general will have that much of an effect on that. Those are my thoughts for now. Let's listen in a little bit longer, but those are my thoughts for now. And in the end, it's also the beginning of the month, all right? So volatility is to be expected, all right? It's expected that huge positions will be opened. And that the market will be filled with new liquidity. But like I said, I mean, we'll listen into this meeting for a little bit longer, but I doubt that it's going to have any big effects. But let's listen in a little bit longer. And if you do have any questions, let me know down in the comments, and I'll answer and I'll type them out. All right.
Failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put our recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see. If you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee.
This can be interesting.
Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. growth, we look at growth insofar as it has implications for our two mandate goals. We look at that, and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay, and just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is...
That's a bit bearish. You would like the interest rate to be cut.
2% over time, sustainably. That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as
Okay. I think that's it. I don't think that if we'll listen to another 20 minutes of that talking, that we will become much smarter. I think that's like most is covered. So to give you a quick summary, in my own words, is that the situation right now is not good enough yet for the Federal Reserve. So what they will do is they keep the rates the same right now, and then the next interest rate decision, I think they're going up. I think the expectation is that they're going up to 5.75%. I think that's still going to be the case, and then next meeting is probably going to be more important, all right? Because right now he's just saying the same as he said the last 5 press conferences after the interest rate decision, which is basically that right now we're doing this, and we don't know what we're going to do. We'll have to await. We'll have to see all of the economic numbers and all the statistics. That's basically what he has been saying for a while now, and that's also what he's saying right now. So there are some things going on, like for example, in the job markets in the US are still very, very good. All right, so they're still they're doing great, which is great for the US. But then the Federal Reserve, I mean, it's not good for the inflation. So then the interest rate still would need to be increased. Personally, like I said, I mean, I very much doubt that this press conference is going to make the market move a lot, which is not, I mean, that's not ideal. It's just, I mean, obviously you came here with some sort of an expectation that we would get big moves, which I still do think we'll get. I mean, if you take a look at Bitcoin right now, what you'll see is that we're basically stuck in this area between 35,000 and 33,500. We're still going to get a breakout, all right? I still expect Bitcoin to get a bullish breakout and to rally up higher. That is what I still expect, but I don't think that this press conference / the interest rate is going to have a big effect on Bitcoin or the crypto markets in general. Right now, you'll see that the dollar strength index is a little bit bullish. That's not reflecting to Bitcoin because Bitcoin is also a bit bullish, which usually they're negatively correlated. But all right, we'll have to see. All right, I'll keep you updated, of course, in the Telegram groups, in the Discord groups, with my videos tomorrow. Also, what you should know is that right now, I actually have my own Patreon, which is filled with, here you can see it, which is... I started a new premium with a lot of great value. I'll post a video on that, I think, in about 30 minutes or so. But check that out. It's I think it has a lot of value. It's very accessible, I think, way more accessible than my Signal group, which you can also access via Patreon. But the normal premium group has a lot of great value. So check that out. All right, I think it has a lot of value for all of you as well. You don't have to join, of course, but it might be interesting for you to check out. I'll leave the link down in the description right now and in the comments. But for now, that was the stream, guys. We covered we covered everything. I think my bias is slightly bullish on Bitcoin, but I'll keep you updated. All right, I'll keep you covered. But for now, thank you for watching. I'll see you all in my next streams. I'll see you all in my next